You know it's bad when the people who used to buy our debt are backing away. The Fed, pulling back. China, out. Japan, not interested. And yet the US government keeps borrowing like nothing's changed. Here's the headline no one's really spelling out. The US, the Treasury market, the foundation of our financial system, might actually be on the edge of collapse. We're talking about a $27 trillion zero-cent market, roughly the size of the entire US economy. If it cracks, it's not just Wall Street that bleeds. It's housing, it's credit, it's your mortgage rate, your business loan, your job. And yeah, Treasury bond prices have already been smashed by 50% since 2020. But it could get a lot worse. In this video, I'm walking you through exactly why experts are starting to sound the alarm, what they're seeing under the surface, and how close we might really be to a full-blown crisis.
$514 billion is higher than any of the forecasts I had seen.
The best approach there would be greater fiscal discipline, which we're not likely to see.
The real risk is in our Treasury bonds, because the folks that used to buy Treasury bonds, the Fed, China, Japan, no longer buying. You've got debt through the roof. I mean, the leverage risk basically shifted from consumers and corporates to the government.
For decades, the U.S. could count on a reliable group of buyers for its Treasury bonds: the Federal Reserve, foreign governments like China and Japan, and big institutional investors. They bought our debt because they trusted it. Stable, safe, predictable. But today, that safety net is falling apart. The Fed has been stepping back, China's cutting its exposure, Japan's not picking up the slack. These aren't fringe players. They have been some of the largest holders of U.S. debt, and when they slow down or walk away, that's a red flag. Here's why that matters. Treasury bonds work just like anything else: supply and demand. If more people want them, the price goes up. But if demand drops, or worse, if major holders start dumping them, the price tanks. And that's not just a theory, it's already happening. Since 2020, Treasury prices have dropped nearly 50%. The government's response? Borrow even more. The debt that used to sit with corporations and consumers is now squarely on the shoulders of the federal government. And it's heavy. In 2025 alone, the projected deficit is nearly $2 trillion, 0 cents. That's not an accident or a one-time thing. That's a pattern. We've been running trillion-dollar deficits for years now, especially post-pandemic. And the only way to finance that kind of spending? Issue more debt, flood the market with even more bonds, more supply, less demand. You see where this is going? Here's the part nobody's talking about. Even if demand for treasuries was stable, which it isn't, we've got a massive refinancing bomb ticking down to zero. In 2025, around $7 trillion, 0 cents worth of US government debt is coming due. That means the bonds we sold years ago, we've got to pay them back. But guess what? The government doesn't have that money lying around. So what do? They refinance, which is just a fancy word for borrow more money to pay off the old money. Let that sink in. We're facing a record deficit while also needing to roll over $7 trillion, 0 cents, in maturing debt. That's like maxing out your credit cards, then opening new ones just to make the minimum payments on the old ones, but on a scale that could break global markets. So now, not only are we issuing fresh bonds to cover new spending, but we're also flooding the market with bonds to replace the old ones. And remember, more bonds means more supply. But if there aren't enough buyers willing to soak that up, prices fall, yields spike, and we enter dangerous territory. This is what analysts are calling the maturity wall. And 2025 isn't a blip, it's just the start. Every year going forward brings more debt to refinance and more pressure on the Treasury market. We're not just borrowing from the future, we're doing it while walking into a buzzsaw. Let's talk about demand, or more accurately, the lack of it. Because even if supply is exploding, the real nightmare scenario is what's happening on the demand side. Investors just aren't seeing US Treasuries as worth the risk anymore. And it all comes down to one thing: the term premium. Now, don't worry, this sounds more complicated than it is. The term premium is basically the bonus investors get for locking their money into long-term bonds. It's supposed to compensate them for the risk of uncertainty, inflation, political chaos, financial instability, you name it. Historically, that premium has hovered between 1% and 2%. That's what helped keep yields and prices stable for decades. But today, the term premium is basically zero. Investors are getting no bonus, no buffer, no cushion for tying up their money for 10, 20, even 30 years. Translation, you're taking on all the risk with barely any upside. Why would anyone buy into that? To make these bonds attractive again, the term premium would need to jump back up to around 1.5%, the historical average. And if that happens, bond yields would spike from their current 4.8% to around 6%. Sounds fine until you realize that when yields go up, prices go down. And a jump like that could lead to another 25 to 30% drop in Treasury bond prices. That's not just a bad day on Wall Street. That's a systemic shock, one that hits pensions, banks, and global markets fast. So let's say this plays out. Yields jump, bond prices drop another 30%. What then? Well, US Treasury yields aren't just some Wall Street number on a chart. They're the foundation, the benchmark for almost everything in the economy. Corporate borrowing, mortgages, student loans, credit cards, it all gets priced off Treasury yields. If Treasury yields rise to 6%, you can bet corporate bond yields are going even higher. That means businesses pay more to borrow, which means they invest less, hire less, expand less. That slows the economy down fast. Then there's housing. Higher Treasury yields mean higher mortgage rates, and in a market where homes are already ridiculously unaffordable, that's like pouring gasoline on the fire. Buyers get pushed out, home values stall or drop, construction slows, it's a chain reaction. And remember, when bond prices crash, that hits pension funds, insurance companies, banks, all of which are loaded up on this stuff because they've always seen treasuries as safe. If those assets start bleeding value, it forces them to rebalance, sell off other assets, or tighten up lending. The result? Liquidity dries up, credit gets harder to access, and the risk of a recession shoots through the roof. This is what experts are worried about. Not just the math, the momentum. Once confidence breaks in the US Treasury market, it's not just a financial story anymore. It's an economic one, a social one. We're not saying it's guaranteed, but the pieces are already on the board, and if this tipping point hits, it won't be a slow unraveling. It'll be fast, brutal, and global. This isn't about fear, it's about facts. The numbers are out there, the buyers are backing away, the debt is piling up, and the foundation we've always counted on, the US Treasury market, is starting to shake. Whether it's a slow grind or a sudden break, something has to give, and when it does, it won't stay confined to a bond chart. It'll hit homes, jobs, credit, everything. So pay attention, because when a $27 trillion zero-cents market cracks, it doesn't go quietly. And that's all for today. If you found this video interesting, make sure you hit the like button, and also don't forget to subscribe to our channel for more of these kinds of videos. Thanks for watching.